All right. Good afternoon, everybody. Bobby Piton here with Preactive Investments. And once again, if you find what I'm doing interesting and you don't have somebody professionally managing your money and don't think that you're capable of doing it yourself with regards to the time commitment and everything else, I think people overall could learn these skills if they put in the time. It is very tedious. I will add that, and you really have to love it. But I think that every single American could probably become a good investor if they really wanted to. But it's going to take thousands upon thousands of hours to do so. So if you don't want to do that and you want somebody else to look at managing your money for you, check us out at preactiveinvestments.com. There you go. There's my little spiel. Anyways, what we're going to talk about today. There aren't a whole lot of companies reporting. And so as such, I'm going to go over a very important concept called net present value, or referred to as NPV. So hello, everybody. Hello, Shiva, Mason, Jose, Uncle Downer, Jules. Glad to see you all. Maybe some more people will join in. I know I'm being shadow banned, I think, of all places, on Telegram. Somebody said they couldn't find me. They couldn't find my name. Go figure. But this censorship is alive and well everywhere. But with that being said, I want to go over this NPV concept. I want to talk about the U.S. stock market. We're going to look at what the S&P is right now. There's been a lot of concern that the market is going to crash, and this has been a live concern for a long time now. I've been hearing about it for a couple years, and I get it. I understand. Nobody has a crystal ball, and we do know that the Fed is doing a lot of shady things with regards to the money supply, and so that doesn't help with regards to credibility. There's a lot of easy money flowing around in the world, and there's a lot of reasons to be concerned. But even with all those concerns, we continue to move forward and climb higher. And there's a saying, the market climbs the wall of worry, and boy, has that been true in the past couple of years. It continues to climb the wall of worry, and it's very tough to ever know exactly when things are going to turn in one direction or another. But what I will say is, hopefully, going through and thinking about net present value, when you look at something, you can use this concept of NPV to make your own evaluation as to whether or not you should buy a stock or buy a particular company, and why. So that's the goal here, folks. Please don't use this as financial advice. It's not meant for that. This is educational purposes only. I'm hoping that people have a couple other things they can think about when they are making investments on their own behalf, or evaluating other managers and so forth, because the math is pretty clean and straightforward. These models are pretty straightforward. Where you get paid is not in coming up with the model. You get paid to figure out how to come up with better estimates than everybody else. I mean, that's what you're going to see when we go through this. Anyways, I'm going to share my screen now. All right. Okay, so here's a net present value calculator right here. Okay, so actually, before we even go to that, I did say I want to show you the S&P 500. Okay, so with the S&P 500, as of right now, okay, just so happens we're doing this NPV calculation today when the S&P is at an all-time high. 44.8742 is what it hit today. So folks, talk about timing. We're doing this NPV right here, right on the all-time high of the S&P 500. We're literally within 0.12 of the S&P being at an all-time high as we're going through this net present value. That's pretty funny. That's just a coincidence, folks. But I want you to look at this chart, and we're going to go back to 2008. Okay, so back in 2008, the S&P, before it crashed, was 1,282. Okay, August 29th, it was at 1,282. It crashed as low as 735. I know it hit 666. That's probably intraday. But what's showing up as a closing print was 735. So 1282, 735. And now you can see that it crashed last year. It went to 2,700. and now it's almost at 44. It's at 4,487. Okay, so remember those numbers. I'm going to show you what it looks like in the calculator. Okay, so now we go to this Excel sheet. Right now, the S&P, if it was a single stock, if all 500 companies was one stock, it's estimated to earn about $200 this year. $200 a share. Okay, the number, I've seen estimates about 190 to 205. We'll just put it right at 200 for simplicity's sake. Now, back in 2008, right here, you can see, I'm going to highlight, whenever I'm talking about a specific number, I'm going to highlight it with the color, we'll do this light green, okay? So right here, back in 2008, the earnings for the S&P 500 were about $60, okay? So $60 a share back then in 2008. So I told you the low was 666. That's what it ended up hitting as an intra-year low. It was 11.1 times earnings. Now, if you use 735, okay, we should just get rid of the dollar sign because this is a multiple, okay? It was 11 times earnings. Now, if you used 735 divided by 60, it was 12.25 times. Okay, that's what the S&P was trading at back in 2008 and 9. This was when things crashed. Now, before it crashed, if you recall, it was at 1282. 1,282 was the S&P. So 1282, look at that. It was 21.37 times earnings. Okay, that's what it was at before it dropped to this. So what did it drop to, folks? It dropped almost 50%. So it goes to show you, drop 48%, how quickly things can go down. Now keep in mind, this was the housing crisis. Nobody knew what the heck was going to happen with regards to the bailouts and so forth of the banks. People really thought that the banking system of the United States was going to collapse. And it was reflected in such in the asset prices of all these companies. And so you fast forward to today, the earnings went from 60 to 200. Not bad. So in terms of, it's up 230. It's up basically 233%, right? It's this number 200 divided by 60 is actually 3.333, right? That's what happens to be one of my favorite numbers. Is 3333, actually 333 is my favorite number, not 33. But anyways, that's a weird coincidence. I didn't plan this, folks. But you can see the earnings are up 233% on corporate America during this time. And the question becomes, I wonder if, your income has gone up 233%, right? That's a good question. Is the average American making 233% more since 2008? And I think the short answer is no. I think that the average American is not making 233% more than they were in 2008. But corporations in this country are. And you can see that the annualized growth rate is 9.7%. So this number is literally taking, it's taking the number, 200. It's taking, we need to calculate the rate. We need to take the number of years. So rate function in Excel. And then we do 0. Folks, this isn't including dividends, by the way. This is just capital appreciation. I just want to make that clear. When I'm talking about, okay, this is what is the earnings of the S&P. This is just what the earnings are. And we're just going to calculate what the growth rate of the earnings was over this 13-year period. There's nothing to do with how did the S&P performance do of the fund. This is strictly what happened with earnings. They were at 200. They're 200 now. They were at 60. How much did they grow per year? This is a rate calculation. It shows 9.7% per year is what the S&P grew at. Okay, right there. So now that number is what I plugged in right here. This is the growth rate that I used for this calculator. So I'm kind of swiveling my mouse here, and you can see in cell D2, you sank my battleship. No, it's actually D2 is the number right there for the growth rate that we're going to use. So we have the earnings, 200. That's this cell right here. E11. We put that, the 200 goes in from there. So if I change this number to 100, it changes everything down there. Simple enough? Okay. So we just put it back to 200. So the growth rate past 13 years has been 9.7% a year. Now the terminal growth rate, I just set at 0. So this is basically saying, at the end of 7 years, what happens? Assuming nothing grows anymore, it just stops growing. It's kind of like just flat on its back. It doesn't decline, but it no longer grows. We put it at 0. So now the discount rate, what I'm doing here is risk-free rate, what you should earn on your money, should be about 3% over time, because the productivity of our economy is about 2.7 to 3.3% a year, is what we're told, right? This is going back 80 years or so, 70, 80 years. The productivity rate of the economy over time, over a 100-year, almost 100-year cycle, is about 3% per year. So it goes the reason that if our society is better off by about 3% per year in terms of how well we use our resources, that to stay even, right, we should get at least 3% more. Our money should get us about 3% more, per year by using the risk-free rate. Okay, so that's what's going on with the risk-free rate. Now, inflation, the Federal Reserve has said it's going to target 2%. So I'm going to highlight that. Okay, we know that inflation is much more than 2% right now. You can look around the world, and we all know that 2% inflation is what the Fed is targeting, but there is no way that inflation is only 2%. It's much higher right now. Now, keep in mind, they're trying to say it's going to fall. Time will tell. The bond market is not reacting, but then again, the bond market is not reacting to where rates are, because the bond market is being manipulated, right? We all know that. It's being manipulated by the Fed. It's being manipulated by these purchases that the Fed is doing, right? They keep expanding the balance sheet. Folks, if you have unlimited ability to print money, you can drive asset prices wherever you want, and regardless of inflation. And that's what has been taking place. So even though there has been real inflation in the economy, interest rates have not, I repeat, have not gone up. And in fact, if you look, we're going to go right here. We're just going to go look at the TLT, right? Look at this thing. This is the Treasury Index. So actually, if we go to CNBC, you can see right here the 10-year Treasury is 1.25%. Hold on. If you guys go to CNBC, you can see that the 10-year Treasury right here is 1.25%. So obviously, you can't have the Treasury at 1.25% when we all know inflation is much higher than 2%. So we're all agreeing to receive less money unless it's being manipulated. So that's what seems to be taking place. Okay, so now the equity risk premium over time on companies tends to be about 3%. That's the historic average. So I'm going to highlight that again. So we're going to go 3. Okay, 3%. On the high side, it could be 6. Okay, this is where it kind of bounces around. This is, once again, this is over 70-year cycles, folks. This isn't what happens in any given year. This happens over a 70-year cycle. So between 3 and 6. Now, what I just used the 3. I'm gonna get rid of this one. Okay, we're gonna make this back to clear. I didn't use the high end for this example. I simply used the 3 plus 2 plus 3. Now, keep in mind, usually you want inflation on top of the risk premium plus the risk-free rate, which 2% inflation on 6 would be about 12 basis points. So technically speaking, if you want to get really specific, you would want to say, if you're modeling this out on billions of dollars, you do care about this 12 basis points. Don't kid yourself. So the discount rate should be 8.12%, not 8%. So because you want the inflation rate on top of the use of your money. Okay? So we'll make it a little more exact, 8.12% versus 8. So now, if we go through here, you can see that this, if the market grows at the same rate, 9.7%, the earnings of these companies grows at the same rate as it did in the past 13 years, what does that look like? Well, it shows that, 1 year from now, earnings will be 219, and then 240, right, in year 2. Year 3, 264. So you get the idea. Kind of keeps chugging away and goes up. 9.7% growth, not exactly the rule of 72, but pretty damn close. You get to 382 from 200. So not exactly 100%, because if you take the number 72 and divide it by the growth rate, 10%, 72 divided by 10 is 7.2. That means in 7.2 years, you would double your money. This isn't exact. This is 7 years, and the number is 9.7, not 10%. But you can see right here that by doing this, how much money was earned, okay? Well, if you took all the money that was earned during this time, over that 7-year period, what do we come up with? We're just going to quickly add it. We're going to say, okay, if everything was paid out to you as an owner, right? They didn't invest any money in the business. Now keep in mind, 0, you don't add that one because that's your baseline. That's what we're looking at as of right now. But if it paid everything out, it would pay you out $2,062. That's what you would receive, okay? Now, the terminal value would be like, okay, well, how much can this thing generate afterwards, right? That's the big question. How much can this thing generate if I hand off the baton? Well, it would generate $382, right? That's the last year. It would be generating 382 7 years from now if this growth rate is accurate. And so the terminal value of that 382, assuming no growth rate, would be about this number, 4,700, minus this number. So you'd be paying about $2,600. So 2642 divided by 382 is 6.92 times earnings. So this is a quick way of showing you that if a company is not growing at all, if it's 0 growth rate, if you want to make 8% on your money, you shouldn't be paying more than about 7 times earnings, right? That's the idea. You should not be paying more than 7 times earnings if a company is not growing at all, and you don't have any good reason to believe that it will start growing, okay? And so now, this number here, this is not, I was just showing this number. I got to subtract out these other ones that I just added because it's not, these aren't part of this initial equation. So the deal is all this money that was made, okay, between this number and this number is 47. Hold on a second here. We're going to make sure we put these in here. Hold on a second. And through 11. Oh, we got to go through, so we got to take this one out. Okay. So all the money plus the terminal value of this, because the terminal value is going to be the last year's earnings, 382.36, divided by D6, which is the cap rate, 8.12%, minus the growth rate. Well, the terminal growth rate we said is 0. So the value of this 7 years from now is about $4,700. Okay? So $4,700, if you use that, I was just showing the differential because you received all these cash flows. If you had to pay $4,700 and the thing was earning $3,800, then you would essentially be paying, hold on a second, we got to do N, 12.32 times earnings. That's what you would be paying, assuming you didn't receive any of those dividends along the way. Because we're breaking, just so that I know what I'm saying might be a little confusing, I'm trying to break out to show you if the company's paid out, okay, I'm going to go to my screen here. If the company's, you want to think about a business, assume you own the whole thing, right? You're buying, let's just say you're going to buy a coffee shop. Everybody can relate to coffee. Actually, I'm drinking a coffee right now. So this is why I brought up coffee. Okay, we own a coffee shop. And this coffee shop is making us, $50,000 a year. We make $1,000 a week on this coffee shop, paying everybody $1,000 a week. So then you ask yourself a question. You say, Bobby, you make $1,000 a week running this thing. The question should be, do you have to be there? Yes or no? If the answer is no, you do not have to be there, then you have a business, folks. You have a business that's saleable. If you as the owner do not have to be there, you have a saleable business. Now, if the answer is I make $1,000 a week in this coffee shop, but I have to be there, and I have to be, then the normal question will be, well, how often do you have to be there? And I say, I got to be there I got to be there 30 hours a week. And it's like, wait a second, are you getting paid for the 30 hours? Well, no, I make the 50 grand. Well, then that's your salary. That's not what the business is making. Let's get two things straight. If a business is only making money after you get paid your cut, okay? If you get paid as an employee, and then what's left after that, that's what the business is truly making. So going to this concept of the business making $50,000, if you are not there, then it's really worth something. So now as a private buyer, or when you invest in the public stock market, you know what you're getting. You're getting $50,000 for that location per year. What would you pay for it? Well, if it's 7 years of 50 grand, 7 times 50 is 350,000. So if you say, okay, there's no book value, and this thing is going to be able to make me 50,000 a year, and you have a very high level of certainty that you'll continue to make the 50,000 a year, then you have to pay 350. However, you need to discount it. Then it's like, well, how sure are you? So the question is, how sure are you that you will make $50,000 a year? The less sure you are, the higher the discount rate that you use. So let's go take a look at that. I'm going to go over here. We're going to use the coffee. We're going to use this example with the coffee shop, and then we'll put back the S&P, because I think this might help solidify what's happening with the S&P 500. Because I want to get people. I want to put people's mind at ease with regards to the valuation, because I do think there's some people that are concerned about how overvalued everything is, and it may not be. Right? Nobody knows for sure, but looking at the data, it may not be overvalued. It may not be super cheap, but here's what I would say. So let's say in this case we're going to put $50,000 here, okay? And we're going to say $50,000. Now we're going to have to expand this, right? Because everything expanded. Okay, so $50,000, and we're going to just say that this coffee shop, it doesn't grow at 9.7%. We're going to just have it grow at, I don't know, let's just say at 5%. We're gonna grow at the risk-free rate plus inflation. So now we say the sucker's growing at 5%. So I mentioned to you 7 years, right? And then you want to possibly sell it to someone at the end. So this coffee shop, if you can discount it at 8%, you would get approximately 1.3. You would pay $1.3 million for this if it was truly growing at 5%. Hold on, let me make sure this is right. Hold on a second, folks. That's not what you would be paying. This coffee shop, if it was publicly traded, the net present, the terminal value plus all the money that you received would be worth this much in cash flows, 1.3 million. Now, if you discount it at 8%, 8.12, you would pay $813,000 for it. So $813,000, if this was a publicly traded coffee shop, you would pay 16.27 times earnings for it. That's what you would pay. If you had confidence that this one standalone coffee shop can make you 5% on your, like a 5% growth rate, you want 8% return, you can't pay more than 16 times earnings for that. You would pay up to $800,000. Now, realistically, what do people pay when they buy a private business? Usually, they want about a 20% cap rate. That's the reality, folks. If you want to buy a private business, you usually want your money back in about 3.5 years. So I'm going to go here. We're going to change this number from 8.12, and we're going to just change it to 0.2, 20%. Now look at that. You would only pay 6 times earnings for it. Welcome, my friends. Welcome to private equity. This is what private equity shops do all the time. They will go and find a coffee shop concept, and they'll offer them 6 times earnings. and they say, you know what, we'll pay you $310,000 for this coffee shop chain. We'll pay you 6 times. And now you'd be like, wow, 6 times earnings. Bobby, why are they buying at 6 times earnings? Well, they're going to figure out how to take it public. If they take it public, they get the pop, right? So all of a sudden, if they can take this thing public and they can get this cap rate down to 8.12, all of a sudden that 300,000 turns into 813,000. So they'll make 160% on their money. That's the deal, folks. If you want to know what drives private equity and drives VC, venture capital, it's this. It's taking a great concept in the private markets and then figuring out a way to take it public as quickly as possible. Okay? That's what they're doing. So this is the formula that you can use. Hold on one second. So right now, let's go back to this with regards to the S&P, because I want to show you what this looks like. So 200, we set an 8.12% cap rate, 9.7% growth. This number here, this is discounted. So we take $219 in earnings a year out, and we divide it, we discount it to the present, right? Which is this number here, this 8.12. And we basically discount all of these earnings over the next 7-year cycle. Okay? And then we do the terminal value as well. And then what do we got? We have $4,210 is the fair price of the S&P 500 if you believe that it's going to grow at 9.7%. And under this model, right? Keep in mind, this model is just one model. You might have a 10-year time horizon. You might have a different growth rate. You might have a different cap rate than me. Based on my assumptions, the market is about $4,210. Now, you say, Bobby, what is the market selling at? Hold on a second. And we say, well, it's selling a little more than that, okay? It's not selling at 4,200, and it's selling at 44.87. That's what you said. So if we say 700, it's selling at 44.86 right now, 44.87. So it's at 44.86. You say, well, what does that imply if it's selling at 44.86? And I say, well, what are you sure about? Which number do you like more? Do you think that the earnings is too low? Maybe it's 205. Maybe it's not 200. Okay. Well, that only gets us up to 43.15. We're still short. Why is it selling at 44.86? Well, maybe people think that hold on a second here. So maybe people think that the inflation rate is going to be 1% over the next 7 years. Oh, wow. If you think the inflation rate is going to be 1%, then the market is worth 49.81. But now if you said it's worth 1.25%, Bobby, based on the 10-year Treasury, if you think the bond market is smart and the bond market is saying 10-year Treasuries are going to be 1.25%, now we're at 47.97. Okay? So let's put this back to 200, 46.80. And you say, okay, the productivity growth rate of the economy, we're showing 3%. And then we say, you know what? We don't want a 3% equity risk premium. We're going to go to 4%. Now it's back to 4,072. We'll go 3.3%. Look at that, guys. That's what I said. The productivity growth rate of the economy earlier, I said is 3.3% on the high end. 44.81. So what is the S&P at? We just looked at it. Hold on a second. I'll just show it up again here. 44.87. Isn't that something? So the market is basically saying it believes that the productivity of the United States is going to shoot back up to not shoot back up. It can go back to 3.3%. And if the productivity rate is 3.3 and the inflation rate is 1.25 and it earns $200 and the growth rate is 9.7%, which is what's happened over the past 13 years, and we only do a low end number of 3% on equity risk premium, you have a fair value of 44.81.45. There you go. So I don't know if that helps, but so now what I did do is I built out, well, what does it look like, Bobby, if we get a 3% shock? So if we get a 3% shock to valuations, i.e. everybody gets scared. Everybody wants the high end of the equity risk premium, which is 6% over time. And they don't want the 3% number. They still think the inflation is going to hold true. They think productivity will hold true at 3.3%. What does it look like if we get a 3-point shock and all of a sudden interest rates shoot up to, the discount rate on Treasury on the market shoots up to 10.55%, right? In this example. So let's take a look at what that looks like if we go up to 10.55%. Okay, so I'm going to share my screen again. So I did it literally right below here, and you can see it's still growing at 9.7. But if everybody just gets scared about a lot of problems, all of a sudden the market goes to 31.53. So the market goes from 44.81 to 31.53. So how much does it decline with a 3% shock? It falls almost 30%, 29.63%. Okay, is how much the stock market would fall if everybody got super nervous and said, you know what, I think it can get really bad. So let's take a look at what that looked like. Okay, back here in 2008, right now in 2008, we're going to just change these numbers. We're going to go, okay, market was earning $60, okay, and as such, it was earning $60 a share in 2008, and it was valued at, let's figure out how it was valued. It was valued at about $13.44. Look at that, $13.44. I said $13.88. So just like that, we punched in $60, and we had it growing at 9.7%. We have a little bit of inside information, folks, because we saw that it ended up growing at 9.7%, the past 13 years. But when you punch in the 60, 9.7%, if when this thing was at 1382, you'd be like, okay, well, the market's fairly priced at 1344. So then what happens? It drops to, if you believe that the cap rate goes to 10.55, the market should have dropped to 946. Okay? So look at that. 946 is where it should have dropped to if you assume that it was going to eventually grow again, right? However, where did it drop to, folks? It dropped to 725 on the closing print, or 666 was the all-time low. So what did that say about the growth rate? I'm going to change the growth rate right here, and let's see how much the growth rate had to come down for us to get to 666. So we're going to take it down. Hold on a second. 1 second. Here we got to go. We're gonna because I got two models here. Okay, this one right here. Okay, we are going to change this growth rate to 0.8%. Okay, and if we drop it to the 0.8%, okay, we're at 866. Okay, well that wasn't enough. So then let's drop the growth rate from 8%. We're going to drop it to 7%. Okay, 7%. We're at 821. Okay, we're still not there. So then we say, you know what? Let's drop it to 0.6%. $7.80, still not there. So we're gonna go down 1.5%. because this is taking a little longer than I thought. 0.45. Look at that. 721. So back then, when the stock market was down 46%, basically you were locking into a 10.55% return as long as the profits in the economy grew at 4.5% a year, which was essentially, look at this, ta-da! What is that? 3.3 plus 1.25 is 4.55%. So when the growth rate essentially hit the inflation plus the productivity rate, I mean, it doesn't get any closer than that, folks. 725 was the closing print. What I just showed you is 722.89. I think it's pretty funny. Anyways, this is how stuff prices, and this type of analysis. This is just one way in which you can price securities and such. You should look into it. You can look into different ways. This is a very simple model that I've showed you with regards to this. What I use is a little more complex than this. And the reason why it's more complex is you can come up with different growth rates through different parts of the spectrum of time. And so you can back out information from how things are pricing through different spectrums of time. And that's called yield curve analysis. You can back out what's expected in the future from the bond markets if you believe the bond markets are accurately reflecting investment decisions of participants in the market. Anyways, right now, the market, is not, it's not overvalued, like it's not excessively overvalued, unless you think there's no way that things are going to hold up, i.e. margins will not stay at these levels. The growth rate will not come in. The interest rate will rise. You have to have a lot of different things at play. Now, the Archangel, he says, what if it's much worse than 2008? There's a saying, what if the queen had testicles? She'd be the king, right? Anything's possible. I guess nowadays, right, people can identify as being a king if you're a queen with testicles. You can say you have testicles as a queen in this world that we live in, and it would be okay. But just like a king can't say, I'm a queen when I have testicles. Anyways, I'm not saying which one's right, folks. I'm just telling you, we need to look at the information. And the information coming out is basically saying what? Things are pretty steady. There's a tremendous amount of liquidity still in the system. And it's very hard to call the turn. So what I do for clients in these times when things are not overly expensive on the index level. Now, keep in mind, on a sub-level, sub-industry groups, sub-sectors, yes, there's a tremendous amount of froth underneath the surface of different sectors and industries. But you can scour and look for situations where you think what you own has a better advantage over the next 5 to 7 year cycle based on how it's growing, what its earnings base is, and you can make your investment decisions accordingly. That's what I get paid to do, folks. This is what I do for a living. I try to construct portfolios where I'm identifying where the value is where I could put money to work with the least amount of downside relative to the upside. And once again, these things are not, it's not as though you buy it and it's going to go straight up. That's not how investing works. Just like you don't buy a house and then you think it's only going to go up. If you bought a house for, $300,000 and then all of a sudden down the block from you, the house sold for $280,000, and it was the same size house as yours, you wouldn't necessarily go and sell your house right away. You'd be like, you know what? I think my house is worth, I still think it was a good purchase at $300,000. I'm not going to do anything. Somebody got a better deal at $280,000. They got a higher cap rate than me. That's life, folks. That's, sometimes people get a better cap rate than you. But that doesn't change the fact that you might have made a good purchase with the 300. And so, and if you look at what the prints are relative to your $300,000 purchase in real time, you might get depressed and do something silly and sell out your house. If somebody else is selling it cheaper. This is what kind of happened in the housing crisis. They played people like a fiddle. They got people to dump their homes, and right before things took off. And this whole concept of creating and stoking fear is not new, folks. There's a lot of really bad actors out there that have been doing this for years, because if you have an edge on information, it's easier to do these things, right? Because you won't get out of the way, right? Like, it takes a lot for me to sell something if I've done all the work. I don't like to buy anything unless I really understand why I'm buying it. And I'm willing to stay the course unless the information really changes, because I know how these things are manipulated. And if you don't realize how they're being manipulated, it's like Buffett would say, if you're playing poker and you don't know who the patsy is after about 5-10 minutes of playing, the chances are you're the patsy, and you should know who you are at the table. Do you understand exactly how this stuff is constructed in pricing, or you don't? But you shouldn't lull yourself into thinking you do if you didn't do any of the work. That's what really kills people, is they don't do the work and they make decisions off of it. Anyways, I hope you guys found that helpful. Have a wonderful day. By the way, I'm going to be doing my thing, day 184 of 365, the greatest book ever written, at about 3:30 today, probably 3:45, because I have an event this evening that I won't be able to do my Bible study at 8:30. So anyways, a comment on news can change numbers. Okay. So you guys have a wonderful day, wonderful afternoon, and I will talk to you soon. Take care.